Hi everybody, welcome to Reunions 2011. My name is Elizabeth Muse and I'm from the Office of Engagement, and I want to thank Clay Crosby, student who's outside helping usher everybody in. I'd like to introduce Karen Bonding, and Karen has worked as an investment professional in the areas of investment consulting, investment analysis, portfolio management, large pension funds, and the marketing of investment services. Karen, for many years, has been an active member of the CFA Institute and has participated in grading the CFA exam since 1985, as well as worked on the CFA exam questions. She served on the Institute Standards of Practice Council and is currently the director of the CFA Program Partner Initiative at the McIntire School of Commerce. Professor Bonding was a visiting professor at the China International Business School in Shanghai, China, teaches investment management and strategy, and has taught some of the same courses at the Institute for Industrial Policy Studies in Seoul, Korea. She now focuses mainly on personal finance areas such as planning and advisory work. Bonding teaches at the McIntire School of Commerce and is very involved with Madison House, UVA's Office of Engagement, the Institute of Aging, OLI, and gives personal finance seminars throughout the semester to faculty, staff, and students. I'd like to let everybody know that this seminar is made possible by Alumni Education Program out of the Office of Engagement in partnership with the Alumni Association. I'd like to introduce Karen.
Thank you so much. Are you all having a good time? It's fun, isn't it? Nice to be back. I have to tell you that I've been gone for the last 4 weeks. 2 days ago, I was sitting in my hotel room trying to catch up on some things, and I noticed that where I was, it was 37 degrees. And then I looked at where I was going, and it was also 37 degrees. The problem, however, was one was in Fahrenheit and one was in Celsius. I was in Reykjavik, and it was just fantastic. If you have never been to Iceland, I can really recommend you go. Fabulously beautiful, but cold. Okay, so what we're going to talk about in the challenge of how we allocate our assets among various asset classes provide about as many solutions as there are pundits talking about it. So whatever I tell you today, you may like or not like, you may agree or disagree, because no one can predict the future. Everyone may be right, everyone may be wrong. Think black swans. As someone said recently, it is really easy to predict, but it's pointless. So with that in mind, let me not attempt to predict the future, but let me attempt to come up with some rational proposals as to how to view asset allocation for various types of goals, various types of accounts, and various types of age groups. Again, I am not trying to give you the one and only right way. I will show you different ways of approaching this task, and you may then agree or not agree. The important point of the presentation, however, is that you must look at your asset allocation. It is not something that you can just leave to chance. Do not put all of your eggs in one basket is about as simple and as wise a suggestion as they come. Not that there aren't people who have done that. Real estate comes to mind, and have made a lot of money. But they probably have also lost a lot of money. But if that's you, and you thrive in such an environment, this presentation will be way too boring, too cautious, too wimpy, so you're forewarned. Now, if you're still in your seat, I will proceed. Let me begin by saying that market timing does not work. People much smarter than I have done a lot of research on this subject, and they say market timing does not work. We should pay heed. Remember that there were people that got out at the top of the tech bubble, but did they get back in time to ride the upside? In our last downturn in 08, 09, Some people escape the carnage by going to cash. I haven't met any, but there probably are some. But did they then turn around and get back in about March, April of 2009? It is a two-decision decision. It's a sell and a buy. So what we really want is restful sleep and not worry about our assets on a daily basis. You can put an asset allocation strategy in place. Review it annually, possibly every 6 months. It should not be any more frequent than that. So here are some ways that we can look at it today. We are mainly going to focus on stocks, bonds, and cash, but we will also talk about alternatives. For many years, pension funds who knew a bit about allocating their huge plan assets had a 60-40 mix. That is 60% in US stocks and 40% in US bonds. In some ways, the world hasn't changed much. Many still have a 60-40 split. It's just that within each of these two buckets, there's been a lot of reclassification, pardon my pun. As examples might be developed and developing markets, private equity, hedge funds, long-short funds, market neutral. All of these are being placed in the 60% bucket. On the bond side, we got foreign sovereign debt, emerging markets bonds, high-yield bonds, distressed bonds, and TIPS. So all of a sudden, we now have all of these options in the 60-40 buckets. So how exactly do we do that, and what type of accounts may qualify or may be large enough to take advantage of these many options? So let's first review the developments from our own personal investment perspective. U.S. equities expanded first into these categories: large, medium, and small cap. Then came the addition of the world, and it's pretty expensive. But how big is the total pie? The total pie, according to Standard & Poor's that I was able to find, was $35 trillion in May. Now, I didn't put the numbers on there, but you can probably see that the blue U.S. and the kind of orange developed non-U.S. are about equal. Actually, one is 43%, the other one is 44%.
Is that U.S. investments or world investments?
Equities. That is global market capitalization of equity markets around the world. Okay? So U.S. and non-U.S. developed are about the same size. What, of course, it also says is U.S. is not half the world, right? So each one of these is approximately 44%, which leaves 12% for emerging markets. Well, when we have to look at our assets, how many may be brave enough to put equal amounts of our money into U.S. and non-U.S. developed, and then on top of that, adding emerging markets, so that overall non-U.S. exposure in our portfolios would be higher than the U.S. There probably will not be a lot of people that would buy into that. One thing, however, to consider is the following. When the dollar depreciates against other currencies, the return that you garner from overseas appreciates. In other words, it gets higher because everything is translated back into your own portfolio if you are a U.S. investor. Now, I'm absolutely not saying that you should speculate about currencies, but it is just something to know, especially when we travel, which I do a lot. When the dollar depreciates, it gets really expensive to go overseas. I think we can all agree on that, right? On the other hand, if we're investing overseas, we can actually take advantage of that depreciation, okay? So it's just something, again, just to kind of bear in mind. Now, let's look at what the U.S. market in equities is like. Research has for many decades shown that small cap stocks, and I don't know if you can see on the right-hand side, the 500, which would be considered large cap, is 87% of the U.S. S&P 500. The mid cap is 8%, and the small cap is 5%. Okay, this is only out of the 1,500, and that was the best I could do under the circumstances. But the percentages will not change too much if you go to Wilshire 5000 or Russell 3000 or something like that. For many decades, research has shown that small cap stocks over time outperform large cap stocks. So rather than just buying the total U.S. stock market, which of course we can do either in a mutual fund or an exchange-traded fund, a lot of people feel that they want some overweighting in the small cap stock area. Some even feel that you should have equal weighting in these three categories. That's fairly brave, but again, some people will indicate that that is the right way to go. We will look at some asset allocations later on, and you will see how there's kind of a middle way here. There may also be an additional granularity, and that is that some people want to distinguish between value and growth. So they will say, well, I want small cap value as an example, but I want mid cap growth. So again, you can cut it finer and finer and finer. Now, let's look at the bond side. It's a little bit trickier, but we do have exchange-traded funds at our disposal, making the task a little bit easier and a whole lot cheaper. So what are the categories that we should look at for our own personal portfolios? U.S. Treasuries come in short, medium, and long-term treasuries, and then, of course, TIPS. Personally, I tend to favor TIPS. It's just my own personal opinion. On the corporate side, we have investment grade, that's the IG. Corporate bonds investment grade, that is generally A or better, A-rated or better. Some people would say it's BAA or better. We also have corporate bonds in the high yield or junk bond category. Those two are not highly correlated. In other words, they don't seem to move very much in line with each other, which some people would then say you should at least have some in both areas. Then we have non-US bonds. And then, of course, we have the emerging markets bonds. Non-US bonds in this would be mainly foreign sovereign debt. Last I looked, Greece was 26%. Any takers? Okay. You could conceivably want a few more categories. Whoops. And here they are. Precious metals, currencies, and commodities. We can buy energy. All of these are available as exchange-traded funds. I believe that one way to simplify the task of how to allocate these various assets just mentioned is to say and honestly ask ourselves, what is my money intended to do for me? Is it a retirement fund that will continue to receive contributions, and my retirement is many, many years away, so that I can take some risk and take a long-term view? Or is this money that I need for emergencies or need to live on? or retire on, or you may already be retired, or is designed for my children's college education, of course, at UVA. I believe it's fair to say that only if you can and you're able and willing to take the long-term view should you truly consider some of the more exotic asset classes, and if the account is large enough. As many of you know, I think, you must be an accredited investor to participate in hedge funds, in funds of hedge funds, and private placement deals. This means a relatively high net worth and a high income, so you all know who you are. Full disclosure, I sit on some boards of funds of hedge funds. What we mainly see in the types of clients that use our funds, they are family trusts, very large IRAs, public pension plans. So again, maybe an area that you may want to take a look at. Usually the minimum amounts are very high, and again, you have to be an accredited investor. But many of the other classes that we've been talking about, international, emerging market stocks and bonds, high yield bonds, and TIPS, they can be used by you and me. We're ordinary investors, and I think there's a very strong enough case to be made to make sure that they're all included in your portfolio. This is a simple 60-40 version from the Wall Street Journal on the April 18. Now, you might be able to see the percentages on the left-hand side. And 1, 2, and 3 are U.S. stocks. Okay? 25 plus 10 plus 5. And that's a total of 40%. Now, small cap and REITs. So these are real estate investment trusts, which are also always, which are also always considered in the equity bucket. Okay? Then we have 4 and 5. We have 10% in non-U.S. developed. In non-U.S. small cap, which is a relatively new category, but of course it follows the same principle as we talked about small cap in the U.S., which have outperformed large cap stocks. So here we have a small cap, and then we have the emerging markets, that's also 5%. So the equity bucket is 60%, 40% U.S., 20% non-U.S., okay? So that gives you a little bit of a clue here.
Is this actual or recommended?
This is the Wall Street Journal, April 18.
But is that what's invested or what they're recommending?
That's one of their recommended portfolio compositions using exchange-traded funds.
And these are typically index funds?
We'll talk about that in a second. Okay. These here, we then have the U.S. total bond market, which would be treasuries and investment-grade corporates. And then we have the additional of 10% in the inflation-protected securities. Okay? So it's a 60-40 bucket, and this is just how it's split up. Again, you can agree that this is, yeah, that looks actually pretty good. It kind of includes some of the things that maybe I hadn't thought about before, but it's in a nice kind of a balanced way, and you may well be able to sleep on that. Okay? The next one is a 70-30 version, which is from something called the AAII Journal. That's American Association of Individual Investors. In my view, the best journal out there. I don't purchase money. I don't purchase any of the magazines that are generally on the stands. This is approximately $50 a year for a subscription. They have an amazing number of fantastic articles, and there are no ads in the journal. I don't know how you would feel about that, but I feel really good about not having to look at a lot of ads. Okay, so here we have U.S. large cap, U.S. mid cap, and U.S. small cap. Again, you will see it's very different percentages than what the pie looked like, right? Because the pie was 87% large cap. So again, you can see an overemphasis on the small cap portion. Then you've got, again, 20% non-U.S. And then this one here is just simply called U.S. bonds, which would be the total U.S. bond market. Again, including corporate bonds and treasuries. Okay? So it's two slightly different versions. Whatever fits for you is right for you. And I'm not telling you which one it is. If you are still contributing to your IRA or 401k, you can put something like these together. We visit it once a year, and then simply readjust your allocations. You don't have to readjust what's already in there, but you can simply readjust then what am I going to do for the next 12 months in my allocation, and then kind of get back to whichever allocation strategy fits best for you. If there is not emerging markets or high yields or tips available in your plans, then make sure you put them into your IRA. As you probably know, your IRA is what we call self-directed. In other words, you can decide what goes into the IRA. And you can choose anything you want, individual stocks, individual bonds, so forth. In a 401k, you are limited to what's being presented to you, what I call a menu of options. Let's, for the moment, walk away from the retirement money and focus on some of your other goals. Let's say you're in or close to retirement. You want to make sure that you have 3 years' worth of liquid assets to cover your expenses. Each year, once 1 year has been spent, you again readjust to make sure that you have liquidity for your daily needs for the next 3 years. That's the most important need you have. You need to be able to pay your bills. You do not want to worry about the fact that I think the market went down this week. I didn't even read newspapers for 5 days, and it was actually really nice, I have to admit. But one day I suddenly opened up, and it was like the market tanked. Oh, okay. I was glad that I didn't read. But you don't have to worry about those things if you have the cash to take care of your daily needs. If you wish to retain equities in your retirement, that is much debated. But if you feel that, I would feel that probably a minimum of 20% in equities, because those are the only things that can grow over time. The bonds give you income, but that's all they do, and not much these days. For your darlings, be they your children or your grandchildren, and they're headed for college in the next few years, the Virginia 529 plan is one of the 5 best in the country. Look at the VEST plan. Virginia Education Savings Trust is what the name of it is called. Even if you are living out of state, you know that you want them to go to UVA, so you might as well get them one of the best plans available. There are tax benefits if you're a Virginia resident, but other than that, the money is fully portable. They can go to any university they want. That's one of the benefits of having that kind of a plan versus a prepaid tuition plan. If you don't want to do that or want to set aside taxable money outside of your 529, I'm a great fan of zero coupon bonds. They're quite hard to find. Sometimes you really have to go search, or you can ask your broker to do a bit of work for you. Equity should be included. The percentage for your children should, of course, depend on the age of the child, meaning that the younger the child is, the higher the percentage. So I've shown you the 60-40 solution and the 7-30 solution. Now let me talk about an age solution. I believe it was John Bogle, he of Vanguard fame, who made this particular solution famous. Think your age. That should be your percentage in bonds. The rest in stocks. There's another version. Think 110. Deduct your age, and that percentage should be in stocks. So you can see they're quite similar with just an ever so slight twist. Okay? A completely different asset allocation strategy, which I found a couple of years ago, it takes 7 asset classes, which is also a little bit misnomer because they're actually also split up. These are the 7 asset classes. Equal weighted. How does that feel? That's kind of a really different strategy, right? Now, within each of these, in U.S. equities, as you can imagine, again, you have 3 categories: large cap, mid cap, and stock in small cap. Non-U.S., you have the developed and the developing world. And then again, you can also put in some small cap, as we saw in one of the other versions. Real estate can actually be had both domestic and non-U.S. Again, that's a relatively new development. Resources, sort of, again, we talked a little bit about the energy, commodities, things like that. Then you've got the U.S. bonds and the non-U.S. bonds, and then cash. So you can see this is quite detailed. You can start out with these 7 categories and say, okay, I'm going to put equal amounts of money into each of the 7. Then how you then split up within the top 3 or 4 categories will, of course, depend on you. And it does depend on, certainly, on the size of the account. But let me tell you what I consider the best news of all. And I always like to finish my presentations on a very upbeat note. This, not just this here, but the other 2, 60-40, 70-30, is so easy to implement. There is no excuse for anyone not to implement an asset allocation strategy, whichever one fits your needs. It can be done with exchange-traded funds. Now, many of you think, well, exchange-traded funds, I got to pay commissions because they trade like stocks. According to the Wall Street Journal, April 18, and these things evolve very quickly all the time, there are no commission exchange-traded funds being sold by Schwab, and I think it's 130 or something like that. It's a lot of ETFs. Vanguard, Fidelity, TD Ameritrade, and E-Trade. You can implement your chosen strategy by a few clicks on your computer. You can add, you could cut back, readjust your portfolio within a few clicks, and it's all at no cost or extremely low cost. These are investment portfolios, and I want to make sure that I emphasize this. These are not trading portfolios. They're investment portfolios. If you want to do day trading, this whole asset allocation, of course, is not for you. And I wish you luck. Let's just put it that way. But, and this is, in fact, John Bogle, again, he of Vanguard fame, does not like ETFs because he thinks it encourages people to trade. I agree with him on that it may. It shouldn't, because we're talking about investment portfolios. So, let me first ask if there's anyone in here that are not familiar with exchange-traded funds, what exactly it is and why they are so beneficial in investment portfolios. Almost 100% of the hundreds and hundreds of exchange-traded funds that are now available, based on index funds. As an example, S&P 500. We're all kind of familiar with index funds because they have existed in the mutual fund format for many, many years, right? You can get an S&P 500 index fund from almost everybody these days. They don't all have 500 stocks in them, but it would be a very, very close similarity. And if you buy an index mutual fund, you might pay between 0.1%, maybe up to 0.3%, or maybe a little bit higher. But that's sort of what the expense ratio generally would be of a mutual fund. Again, I sit on boards of mutual funds, so I kind of know what all of the requirements are for mutual funds by the SEC, by rules, now the Dodd-Frank bill, and so forth and so on. And there's a tremendous amount of legal work that has to be done and completed for mutual funds. So exchange-traded funds can also be had in an S&P 500 format, but they're not mutual funds. So they don't have all of the regulatory requirements in the same way that a mutual fund does. In other words, you cut expenses. See the difference here? And you can have, I haven't looked recently, but I would think 0.04, 0.05, 0.06 in that area of the U.S. equity index ETFs. Okay? So they're even more efficient in that the expenses are lower. But what makes exchange-traded funds so incredibly efficient is that if you think of a mutual fund, and you think of a lot of people piling into a mutual fund, right? So it generates a lot of cash. There's a lot of cash going in. On the other hand, another time, a lot of people want to get out of the mutual fund. And the mutual fund then has to sell stock. That is not the case in ETFs. Okay? Now, if a mutual fund sells a lot of stocks, what does that generate? Not only capital gains or loss, yeah. And so all of a sudden, now you, as a holder of that mutual fund, has to pay capital gains taxes. You didn't have anything to do with it, but you have to pay capital gains taxes. This is not the case in an ETF. You won't have capital gains taxes. So they're incredibly tax efficient. I mean, you can use ETFs in any kind of a portfolio, okay? Taxable, tax exempt, whatever you choose. But if you use them in a taxable account, it is really, really to your benefit. Because not only are the expense ratios very low, in other words, it's cheap in that respect to hold them, but also they'll follow an index. In that respect, of course, they're pretty tight. But you don't have the capital gains tax phenomenon.
Is there a reason why 401ks and 529 plans offer mutual funds rather than exchange traded?
I'm beginning to see that some 401k plans are beginning to offer ETFs, but it had to do with the fact that, think of a lot of people putting in maybe $100 or $50 a month, and they had to pay the stock commission. Now that that has been taken away, the 5 companies I mentioned to you, where you can buy a lot of these ETFs without having to pay commission, then of course the 401k plans could start including them. And I'm beginning to see a little bit of that around. Yes?
Could you talk a little bit about TIPS and why you favor TIPS? TIPS?
Treasury Inflation Protected Securities. Can I just get back to you in just a second? Okay. If you're interested in the ETFs, I will give you the website that I have found to be the best. And they list all of the ETFs. There's no discrimination about any that come from State Street or Goldman Sachs or whatever. And it is etfdb.com, okay? So it's very easy. And it has, you can see in the middle there, the guide to ETF investing. And then, if you click on this thing here called Category Reports, what you will see, I'm going to try to pull it down so you can see at least most of these. So you can see, I mean, just starting from the left-hand side, I don't know how many people want to buy California municipal bonds, but okay, you kind of get the picture here. But you can see in, for example, commodities, agricultural commodities, metals, oil and gas, precious metals. Under currency, I'll just show you what just one of these categories look like. I'll just click on currencies. And what you will be able to see is they have 3 of them. They have one US dollar index bullish. You got Australian dollars, you got Canadian dollars. I believe there is also one for euros, but it doesn't show here. If you click on, what do we want to look at? Oil and gas. Let's just look at oil and gas. Oh, that's right. These actually don't show all of them. Here it is. View all ETFs in this category. And this is when you will now see, just in this category alone, okay, you will see that it has natural gas, oil, crude oil, oil, energy, so forth and so on. You will also see that they will generally show the largest in market cap at the top, and they go down and become very, very small. I encourage you to stay with funds that have been in existence for a while, that have some history to them, but that's really all. I mean, other than that, it is really totally your personal choice.
Quality of management exists in all of these funds?
Well, right, yeah, I hear you. I tend... the quality of management, the quality of management in these funds. Again, remember, they're mainly based on indices, which is not made up by these people who manage them. So, I mean, it's not a conflict of interest. This one here does not have a lot of iShares. I tend to stay with iShares. A small I and then capital S, iShares. iShares were originally, is one of the very, very large groups, was originally started by Barclays Bank, which is a UK bank, sold to, or taken over by, I think it was Wells Fargo. It was a California bank, I can't quite remember. But iShares are now run by BlackRock. They purchased the entire family of iShares. And I don't know if you know anything about BlackRock, but it's the largest investment manager in the world, has several trillion dollars, extremely well regarded, very high reputation. So I don't have any problems with when I see something called iShares. This one here, because it's a little bit unique, let's see if we can find another. I can certainly show you another one that will indicate a lot of the iShares so that you can kind of see what it is that I mean. We can just take all cap equities. As you can imagine, this one is huge. Well, it starts out right there with iShares, right there in the middle. See that? This is a Russell 3000 in the Dow Jones. Vanguard, of course, also has a lot of their own ETFs now. But here you can see iShares, you can see Vanguard is up at the top. Lots of iShares, Vanguards, Wilshire, and I don't have any problems with any of those.
Vanguard, excuse me, raises a question for a non-taxable account. Vanguard also has a total stock market mutual fund.
Yeah.
You have
one has a lower expense ratio. And again, remember the tax efficiency portion. It's the same stocks. It's exactly the same stocks. It's just how you buy and sell them. See, the other thing, and I will get to your question, the other thing about ETFs is you can put limits on them. You can short them. I mean, you can actually do some very, very interesting things with ETFs that you can't do with mutual funds. And again, it's not a trading vehicle per se. But for example, when I go on long trips, which does happen 4 to 6 weeks, I go very, very closely through a portfolio to make sure that if I don't want any surprises when I'm not reading the newspaper for 5 days or a week, I put a stop loss order on so that if the market has like a October 1987 surprise when the market was down, I don't know, 12% or something like that, my stop loss orders will kick in, okay? And I don't have to worry about it. Very, very rarely do these things happen, but it is a protection that you can put into your portfolio. Doesn't cost anything. It's not, you know, it's not like you have to pay a lot of money to do that. So does that help you? Yeah, it would just go to cash. Yeah, it would just go to cash. So, okay, to the tips. Treasury inflation protected securities. Trying not to get political. It's difficult. America is borrowing a lot of money. Just like some of us did on our credit cards, or some of you did on whatever. America is overextending. And at the moment, I don't see that stopping. And you cannot continue to print money. Just like you could not continue to use your credit card and borrow from somebody else and not one day coming to the reckoning that you're broke. Completely, totally, utterly broke. And I am fearing the path that the United States government is on as far as borrowing money. That's my personal opinion. And usually what happens, or has in the past, is that when you print money, inflation goes up. I'm getting, I think, close to retirement, although I have to be honest with you. I have the best job in the whole world. I absolutely have the best job in the world. If you have never taught a class, you should try it sometime. It's just fantastic. So I love teaching, and I don't have any reason at the moment to give it up, but obviously the day comes when I will. And by having inflation-protected securities, at least that part of my bond portfolio will keep in tune with inflation. Because if you think of buying a bond, let's say it gives you 5%. Okay, that's fine. Every year you get 5% on your bonds. But if you all of a sudden up the inflation rate, then yes, the 5% will come, but it's worth less and less. And inflation-protected securities, they're government securities, so supposedly they're not going to default. And they will raise the principal value and also the income value every year by the rate of inflation. So that's why I like them. They have the backing of the U.S. government, and they also have the addition of the inflation. So, and again, you can purchase them as ETFs. In fact, there is now an ETF, which I also find very interesting, and I do use it, for non-U.S. countries. And for China. So you can actually protect yourself against inflation coming from outside as well. Yes, sir.
I'm a 62-year-old total novice
Okay.
who has followed a practice of benign neglect,
Okay.
which has worked out okay.
Good for you.
My question is, how do I now find a really good financial planning advisor who's not there to sell me something? How in my community do I find someone like you?
Yeah, that is probably one of the hardest areas. I completely agree with you because it's pretty black and white in most cases. Either you hire an investment advisor or a broker or some sort of combination of that, right? I don't know where you live, but they're probably available in your town. And most of these people, not all, but most of these people want full discretion over your portfolio. And they obviously love to buy stocks and bonds individually. So you have this, right? Or they will buy mutual funds which have loads. And so they will charge 5.5% or 5.75%, whatever it might happen to be on the mutual fund. And if you say, well, hey, wait a minute, it's my money, and here's what I want you to do. And then he will say, well, you either do it my way or we're parting ways. Very, very difficult. Very, very difficult. I was extremely pleased. I do have to say that. I will not give the name at this point. But I found actually an advisor here in town. Charlottesville, is pretty advanced in many areas. But I've always been very hesitant when people have come to me and said, I've got this money, I need somebody to manage it. I don't want to have the hassle. I don't want to go online or, some people don't want to do anything online, right? Yeah. Well, you're very good that you're even admitting, hey, this is not my expertise. I'm not interested, but I know I need to do something with my money. That's what I'm hearing from you, which is great. I have found a firm here in town. From what I have seen so far, I would trust them implicitly and give them money. And they will work with you. If this is where you feel comfortable, this is what I would like you to do. They will charge 1% of your assets, okay? But they don't take over, if you see the difference here. And that's the kind of people you want to work with, is that someone who is not going to say it's my way or goodbye, that will actually work with you. They will still charge 0.75% to 1% to 1%.
If I have a defined benefit pension.
Oh, you're so lucky.
I'm a great employer. And I'm wondering if you have a defined benefit pension expectation or some reason annuity, how should I figure that into the rest of my retirement asset allocation? How do I mean, obviously that's protected, so it suggests that I should be more aggressive with the rest of my portfolio, but I have no idea how to make that decision.
Right. Just a second.
Just summarize the question.
Yeah, well. Okay. Oh, right. Yeah, okay. This gentleman has a defined benefit plan. Defined benefit plans in the old days was just simply called a pension plan. United Airlines, General Motors, railroads, okay? And we all know where those went. That's the problem. You were saying, and I think your words were, of course, I am protected. I think those were the words you used.
It's highly insured.
Yeah, well, thank you. Yeah. You still obviously need to save. And you still need to be prudent about your savings. No doubt about that. I mean, we can think of one really bad example in this country, not just AIG, but Enron. Enron purchased a company out in Portland, Oregon called, I think, Portland Gas and Electric, or some such thing. And here were these people, and they were all pensioners, and everything was fine, and they were getting their income. And Enron purchased a company. That was all fine and good as well. And all of a sudden, of course, one day, the checks stopped. These people had never worked for Enron, probably didn't even know what it was. The pension was assured until the day it wasn't. Does that make sense? And that's the danger. That's the danger. We all know how underfunded a lot of pension funds are. Okay. save outside and maybe make it a little bit interesting. I mean, you can, for example, go through these categories of ETFs and say, you know, maybe currencies, maybe commodities, maybe precious metals. Maybe there's some other particular interest of yours. And I would, you know, start small. Now, most of those will actually have a commission, but if you have an account at Schwab or E-Trade or something like that, TD Ameritrade, I think the commission right now is $7.99 or something like that. So it will be relatively small. But try it out. The wonderful thing to me about ETFs, as opposed to buying one stock, is, of course, you've got much less risk. And that's another reason I like them.
If you believe the efficient market theory, what do you say on tips? I keep toying with it, but if you believe the market's ability to see the future, then that's in the price of the tips versus their alternative of treasuries or bonds. And are you really buying what you think you're buying, or are you just buying the product?
Yeah, so the question is whether we're buying what we think we're buying if we buy tips. I don't mind admitting that I have been wrong now for like 3 years, okay? Because we haven't had any inflation. That is, of course, inflation if you think of the way that it is being measured officially. We all know about the gas pump. We all know about the supermarket. But the Federal Reserve doesn't seem to know about that. And the statistics, at least, doesn't seem to. I don't know if the price of the iPad offsets the increase of food. I mean, I don't know, but the CPI doesn't seem to have a lot of relation to the rest of it. Can we be fair about that? So you're absolutely right. The pricing of the tips right now does not indicate that there's going to be a lot of inflation ahead.
But even with just an absolute dollar basis,
Yep.
I mean, the market may very well price it or overprice it. So
Yeah.
buying a product that people are in demand, willing to pay for, and at the end of the day, you may have actually less cash in your hand.
Yep. Yeah, I do not disagree with you. I do not disagree with you. And I certainly don't have a solution. But again, this is why any category, you know, some people say emerging markets, absolutely not. I will not have anything to do with that. That's okay. It still belongs in your portfolio. Put it at 5% because you don't know. Remember, none of us know what the future is going to bring. And this is why the categories that I showed you to include in a proper allocation, I believe are valid. You can fiddle with the percentages, but if you don't put in emerging markets, think of it this way. How many have been to China or India or both? Okay. Is that where half the world's population live? Is that where the growth is? It has to be. So why would you not invest there? And do it prudently. Do it through an index fund or, again, the ETF types of index funds. It's where the growth is.
What are your thoughts on target date retirement funds?
Target date retirements have had, you know, a lot of ups and downs, as we all know. I feel a little bit about those in the 08-09 downturn. You would see the headlines, 401k plans don't work. What exactly was it about the 401k plans that didn't work? Nothing. They worked just fine. They worked exactly like they were supposed to. The target date retirement funds, I feel a little bit like that. There is no one right solution. I mean, that's what we all have to kind of wrestle with. There is no one right solution. I do recommend them. I have a couple of former students here. I think they will verify what I said. I recommend them because I don't have to worry about it then. And especially when students come right out of college and it's one of your options in your 401k plan, just go for it. Just put it in 2050 or something like that. That's just fine. And just keep putting money into it. You're not going to lose it. It's going to go up and down, but you're not going to lose it. Okay. Later on, when you get more experience and you get married and you have children and there are other things in your life from an investment point of view that become important, then you can add to that or complement it. Do some additional work with it. In most cases, T. Rowe Price, Fidelity, and Vanguard, I think they all do a fantastic job. Again, nothing is perfect, but I do like them, especially for young people.
Are you paying double expenses with retirement, with the time retirement funds? They're putting the money into mutual funds.
Yep. Well, you are. You know, nothing is free. I mean, you can put a target retirement fund together yourself, and again, with the ETFs, you know, you can say, oh, you know, the Vanguard, I think they use 6 funds right now. Oh, I'm just going to use their ETFs, and I can do that myself. Do you really want to? Do you really want to have the hassle? Yeah, I mean, absolutely you can do that, but I'm not sure I would recommend it.
When you mention ETFs, are those always bundles or buckets of funds rather than individual funds?
One ETF is a bundle of stocks.
Okay.
Or bonds,
Stocks.
or currencies, or whatever, yeah.
But it's almost like an index.
It is an index.
Okay,
it is
it's
a group. And it might only be 10 stocks.
So you're diversified within that.
Exactly.
Class.
Exactly. That's what I mentioned to this gentleman up there, is outside of his pension plan. This might be one way for him to maybe biotechnology. I have no idea what your business is, but you know, something like that you can choose a sector, just like the energy sector. I mean, there are windmills, or alternative energy ETFs. There are water ETFs. You know, I mean, you can do some very interesting things with them.
You mentioned a website that was interesting for ETFs, and you mentioned different asset allocation. Do you have a recommendation for one book for a non-traditional view of asset allocation and investment? I hear a lot of similar things from different sources, but I'm looking for I don't want to say the word contrarian because that has a different connotation in different places, but where's the alternative? What's the other side to a random walk down Wall Street or something like that?
Yeah, like the, can we go back to the, okay, just a second here. And I'll do this again. And what I always want to make sure that you understand is that I am not selling anything. I am only recommending what I have found to be the best. Now, of course, I don't have my little pointer, but is it here? Oh, for the red dot. Yeah. Okay. Right. Thank you. I have, again, this is from the AAII Journal, and you can put in, I think it's aaii.org, not .com. I think that's correct. And this was what they called the moderate investment portfolio. So they would have one that would be stronger, one that or more aggressive. And I just simply find that their material is about the best. Burton Malkiel, who of course is the father of Random Walk, he and John Bogle basically put a book together that I like very much. It is absolutely as simple as they come. It's a little out of date now. He has also changed his mind on one thing, which I'm very glad to see. He did not feel that you should be in non-U.S. stocks. He felt that you could buy Microsoft and you could buy Boeing and General Electric and stuff, and you would have all the international exposure you wanted. Not in my book, okay? You need to be able to buy a Siemens. You need to be able to buy a Nestle. You need to be able to buy Infosys and all of these kinds of companies. But he has changed that. I've seen that recently. So he's very good.
Let's say you have a collection of ETFs and you're following an allocation strategy. You've got 10 or 12 ETFs in those. What's the best way, or can you recommend some resources for how you actually measure your return? That's the big challenge.
Yeah. So the measuring of the returns, if we have, it doesn't matter if they're ETFs, it could be mutual funds. One of the things that I've noticed I happen to have an account both with Vanguard and with Fidelity, so I kind of see the new stuff that they put out from time to time. And you will actually get a return. It will show you like the last quarter, the last 12 months return of your total overall portfolio. And it might be your account, your wife's account, combined account and stuff like that. So it can show it all together. Because, of course, money goes in, money comes out. It's really difficult. You can't do it by yourself. So if you are with a company like that, and I would suspect Schwab, I don't know, but I would suspect Schwab or TD Ameritrade or something like that would do the same for you.
It might be worth pointing out that the Labor Department has changed the rules on disclosure of costs, and that in October of this year, fund providers are going to have to break out all the hidden fees that they charge, and that will be a real.
Yeah, I know. The Labor Department wants everybody to know everything and all of these fees. And, I'm old enough to have gone through when the 401k started in the 80s. There are always a few bad apples out there. And unfortunately, they're the ones that then make the government sit up and take notice and say, oh, we better put some rules in. If you stick with the major companies, I don't see any problem with information given to employees. I really don't. Again, sitting on a mutual fund board is a real eye-opener. Reams. And I can get quarterly board books, and I am not exaggerating. 1,000 pages. It's all legal stuff. And that's every quarter. Unbelievable. And it's getting worse because of the Dodd-Frank Act, as we all know, which of course hasn't, the regulations haven't even been written yet.
Which increases costs.
Completely increases costs because all of these companies have to hire more compliance people, more accountants, more lawyers. What do? They do paperwork. There is nothing productive in the GDP kind of productive measurement. We're just getting paper pushers. I'm sorry, but that's where I feel this is going. Not the right way.
We're probably one of the oldest here. About to hit the point where I have to take withdrawal from non-taxable accounts.
Right.
In reality, most of that will probably go to the next generation. What do you recommend for a strategy to minimize what Uncle is going to take, and it looks like it's going to get even a lot worse?
Yeah, it's definitely getting worse. And of course, we're going to have to pay Medicare on those amounts of income and stuff like that. Yeah, okay. What's the right way to do that? I don't know. What we have certainly seen the last 2 years, and again, this is, in my view, an incompetent government, in that they haven't told us until December that we could take withdrawals from our IRA and put them into charity, tax-free, in December, when everybody has already done their 12 deductions, right? I mean, it's insane. I don't know what the right way is to do it.
I mean, the thing is, how do you minimize, is there, most of it's going to be gains, it's not actually go in. So how do you, what's the strategy to minimize the uncle's take of that as you draw it out and be able to pass it on to the next generation, or is there a way?
Not that I know of. Not that, I mean, there are certainly estate planning issues, and there are certainly some people here at UVA in Affairs Department Development, Office of Engagement, in whatever college you came from, whether it was a college or whatever, that will help you with estate planning. Frankly, if I find people that have a few $million, and they're asking questions like that, I say give it to charity. I mean, what is Bill Gates and Warren Buffett doing? Well, if it's good enough for them, it's good enough for me. I don't have millions to throw around, but I sure know that charity is the right way to go. That's how I feel. One more.
Earlier you talked about the ratios of equity and bonds and your net mix, and to establish a ratio and stay with it, reevaluate it once a year. My radars are reading everything, and I see the national state debt, I see increased energy, rebuilding Japan, and I keep saying to myself, how should I reallocate my asset portfolio to get a larger return on investment? How do I ignore those impulses, or should I listen to those impulses and do this once a month, or, contrary to your guidance?
Turn on the television and drop your subscription to the Wall Street Journal. No. How do I allocate my assets? Okay, let me ask you this question. Are you more concerned about high return, or are you more concerned about safety? Because those two things could be different. Yeah, well, see, that's the problem. It depends on what day of the week it is, what month it is, and yeah, I completely agree. I mean, it is not easy. In fact, haven't we all felt this thing, why did I bother reading the newspaper today? Because it was just all bad news. Have you ever had that feeling? Yeah. But you can certainly take the suggestion I did of take your age, whatever it is, and say that's going to be my bonds. And again, you have different bond categories to choose from. They're not highly correlated, so you should have a fairly good, decent return. I would say in the 5 to 7% area. And then put the rest in some index funds. That's what I would do if I were you, because that will give you sleep. It will not make you sleep deprived, let's put it that way. That would be my measuring stick.
Thank you.
Okay? Yes, sir. Oh.